Beautiful bounce and close in the S&P 500, but we are not out of the woods yet, guys. So in this video, I'm going to be giving you my up-to-date stock market analysis, where I think the market is going in the short term. As I told you, we just hit the 10% correction on the S&P 500. I expected the quad witching day, which was last Friday, March 21st, to be volatile, but we ended up closing in the green. So in this video, I want to give you the latest stock market analysis, what data drops and events you should be watching out for this week, as well as some updated stock charts on individual equities like Tesla, Nvidia, AMD, etc. Let's get right into it. So if we take a look at the S&P 500 here, you can see on the SPY that we bounced off of the 300-day moving average. We were also in a daily fair value gap. Now, here's the important part. It looks like we are on the cusp of potentially making a new higher low. This would be the first higher low in this entire series since February 19th. Also, fun fact, there's also only one day that we closed above the previous day's high during this entire drop. And it was Friday, March 14th, which was a 90% upside day, something that we talked about on this channel. Monday, March 17th was also a 90% upside day. So back-to-back 90% upside days. So this right here was the first time that we closed above the previous candle's high. This hasn't happened in this entire rally. So we had that now a couple of times. Closed above the previous day's high, closed above the previous day's high. Also, Wednesday closed above the previous day's high. So we are seeing this now forming what looks like a potential base. And if this right here is a new higher low, then this might be the first launch point for a potential short-term rally. But in my opinion, this week coming up, we need to close above the high of last week. So you can see that there's a couple of equal highs here. The high on the SPY was 570.95. And if we flip to the SPX, which will be relevant for a reason that I'll talk about in a second, the high on SPX was 5715.33. SPX is the index, SPY is the ETF. But we need to close above the previous week's high in order to see a potential rally, a short-term rally that can take us close to that 5,800 level on the S&P. Now, as I've talked about before, relief bounces generally last longer than people expect. So as I said before, everyone wants a bottom to be a V-shaped bottom. And if it's a top, they want an immediate drop off. But in 2022, we spent a couple of weeks consolidating after hitting the apex of this relief rally. And in 2018, we spent almost a month here before finally dropping off once again. Now, a couple of things to consider here with the S&P 500. If we take a look at the gamma, you can see that at that 5,600, 5,605 level, we have the most negative gamma exposure. These are two different expirations, just a day apart. This is the 24th, this is the 25th, but the point still stands. That 5,600 right there is a very large negative gamma exposure level. Now, what this means with a degree of subjectivity is that market makers are net short gamma at this level. And so in order to remain hedged, they would need to buy the underlying stock to make sure that they don't get blown out. This is why some options traders use the gamma index for support and resistance in the short term, because when market makers sell you these puts, right? This means that a lot of retail or institutions are buying puts. So when market makers sell you these puts, the market makers, they are short gamma, but they also have a disproportionately long exposure because they sold you the puts. So buying the puts is bearish, selling the puts is bullish. They don't want to be overly bullish, so they go out and short the stock. Now, if the price starts rallying from here and market makers are net short stock, then they have to keep buying the stock in order to remain hedged in their position or to not be overhedged in their position. And that's what fuels gamma squeezes from puts. We know gamma squeezes from calls like back in the GME days, but gamma squeezes can also occur from too many puts. So if this right here, this 5,600 level holds and price starts rallying from here, then you will likely see market makers have to buy that stock back in order to close their short stock hedged on the puts that they sold. I know that this is sometimes complicated, but rewind the video and see what I said. And you can hopefully understand the really complex dynamics there. Now, the flip side can happen. If the 5,600 level gets sold off, then the market makers will have to continue selling shares, shorting the stock in order to keep hedging as their position gets more and more severe. Now, the flip side is also true, meaning if we breach past this 5,600 level on the SPX, past the 5,600 level, which right now we're at 5,667. If we fall convincingly below that, then market makers will have to continue selling as we fall below that wall. That is because they will be losing a shit ton of money on the puts that they sold the traders. So the more that the delta increases on these short puts that the market makers are short, the more they will have to continue selling the stock in order to remain hedged. So with this type of data here being this skewed, we are still in a very precarious situation, or very, I should say, sensitive situation here. If we fall below 5,600 significantly next week, then we could see a crap ton of selling and take out this low. But here's why I think we'll see a short-term rally. I think it's more likely that we see a short-term rally instead. This right here was the best volume on the S&P 500 on a green day in a very long time. You have to go back to December 20th of 2024 when we had this 4-day rally to see volume even close to that. Also, if we take a look at the VIX here, this right here was the VIX last week. What do you notice? This right here is the VIX expiration. Remember, the VIX is a futures contract, right? A lot of people think VIX are options. There are options on the VIX, but they are based on the VIX futures contracts, right? So the VIX futures, this right here is called backwardation, where the current VIX is higher than the VIX that is coming later, the succeeding VIX, right? This right here is not normal. This means that we are at peak fear currently, even more fearful than the market is in a month, 2 months, 3 months in advance. So this is how the VIX looked last week. If we take a look at the VIX now, the VIX is back in what we call contango. Contango means that every single VIX expiration in the future, the spot is higher than the current one, because in a normal situation, traders want to get paid a premium for taking risk that is further out, since there are a lot more unknowns. So when we see this type of, minus 10%, 300-day moving average, high volume, potentially the first higher low in this whole ordeal, in this whole ordeal, when you combine that with the fact that the VIX just turned quote unquote normal for the first time, the likelihood goes up that this may be a true base where we could see a short-term rally. Now, I'm not personally in the camp just yet where we see a blow off top. And that is because of a couple of reasons. One, after back-to-back 90% days, 1 to 2 weeks later, most of the time we make a new low after the second consecutive day. That would be the low of Monday, March 17th. And secondly, because of the unknowns as it relates to tariffs. So when the first tariffs were announced and put in place in 2018, we did see an initial pop in the market, but then we saw another drop. Now, obviously, this is more of an unknown because I'm not in the Trump administration. I don't know what they are going to announce April 2nd. They could just come out and say, hey, guys, you know what? No more tariffs on Mexico and Canada. We worked everything out. And on China, I'm on the phone with President Xi, and we're also working stuff out. What do you think is going to happen then? I think, in my opinion, we get a new high in the S&P 500. So I'm not Nostradamus. I cannot comment on stuff where I just don't have all of the information. My analysis is based on the information that we do have. Also, we talked about this before, but the Fed last week just said that they are going to basically pause QT. They're going to cut it back so significantly that it basically doesn't even count as QT. They're going to go from 25 billion of assets rolled off per month, of treasury assets rolled off per month, to 5 billion. That is an 80% pause in quantitative tightening, and we could see some positive liquidity reverberations in the market due to that, and hopefully a continued drop-off of the treasury yields. And lastly, I'm very curious what the Trump administration and the Treasury Secretary Scott Bessent, what is their goal for the 10-year? They did explicitly say multiple times that their focus is on bringing down yields, but what is going to make them happy? If yields come down to below 4, if the 10-year comes down below the low of September 18th, I'm not sure what the target is. And as of now, I can't find one. So until they change their policy on attacking yields, it's very hard for me to imagine that the S&P 500 is just going to continue to see a blow off top and continue upwards. I do think we will see a short-term rally. I think that rally might be somewhere around the 5,800 range. We do have a low here that is going to act likely as strong resistance. There is the 200-day here, but somewhere between the 200-day and the 100-day is what I'm eyeing for a little rally until I hear a change in direction from the Trump administration and maybe some further clarity on tariffs. Now, that does not mean that we should not be buying some of these fantastically priced stocks. More on that when I get into the trade section, but I just want to quickly go over what events should we be focused on this week. We have PMI on Monday, which is great for those of you that day trade with us. Any day that has news like this brings about the volatility that we love when we day trade. We have new home sales on Tuesday, not a huge amount of news. We have final GDP on Thursday, and we also have core PCE on Friday. And just with regards to the GDP, I did some research, and since they've been releasing the GDP Now estimates in 2014, the Atlanta Fed, there has never been a time when the Atlanta Fed forecasts a negative GDP like they forecast now, with the actual GDP not coming out negative. So it is common for them to change this very quickly before the release, which as of now is on April 30th. But if the GDP here remains negative from now until right before April 30th, then I would have to imagine that the actual GDP comes out negative as well. Now let's get into some trades and some stock charts here. And as I told you, the data on buying corrections speaks for itself. So when we hit a correction and we have back-to-back consecutive days of 90%, a year later, almost 100% of the time we are green. Even 2 months later, almost 100% of the time we are green. Now, I've told you guys that my strategy when it comes to the indices that I've been implementing for over 15 years, I never let the indices fall 10% without buying them. And I'm only really talking about the two major indices, the SPY and the QQQ, the S&P 500 and the NASDAQ. So when they drop 10%, I buy them. And I don't buy them again until they drop, if they drop another 10%. So if you implement the strategy and you're a long-term investor, we're not talking about day trades here just yet, but if you implement the strategy and you are a long-term investor, this type of dollar cost averaging will save you in deep bear markets like the one that we had in 2022. So if you look at this, the first time that we hit 10% was at the 300-day moving average. When we finally hit 20%, it was at this level here in March of 2022. When we finally hit 30%, it was in May of 2022. And when we finally hit we didn't actually hit the 40% range, but we hit the 35% range. If you did that, you would be profitable almost immediately after doing that versus someone who doesn't buy and they bought somewhere here, they bought the highs, they were scared out of the market and they didn't buy again until later. In 2022, you would have been spared. It would have only taken you a year before you got your money back, a little over a year before you got your money back. But in some really deep bear markets, like in 2008, it took 4 years to get from the high in 2007 to the high in 2011. If we go back to the year 2000, that is even crazier. In the year 2000, we put in the high in March of 2000. We didn't get back to that high until 2016. So 16 years later on the NASDAQ. The S&P 500 is a little more forgiving than that. But that's my point is you do not want to be someone that buys the highs and then just holds on and waits to get back to break even. You want to, in my opinion, obviously you do what you like. You want to actively buy the indices in minus 10% increments. Now, when it comes to Nvidia, let's take a look at some. Right now, its PE ratio has gone up. I told you guys Nvidia was super cheap when it was sitting at the 105 range. But if you look at Nvidia right now, Sure, it's not super cheap in terms of current PE, but the forward PE is 27, which is lower than the 3-year average of 71 and the 5-year average of 72. Now, if you were short-term long on Nvidia, I think that there is a plausible profit taking at around 127. You have the daily fair value gap there. You have the 200-day moving average. We do have this downtrend line, which Nvidia can certainly hit. And if we take a look at the gamma data, you can see that Nvidia does have a level between the 130 range for the April 4th expiry. We also have the 123 range for the soonest expiry. So that would really support that level between this daily fair value gap and this trend line here. Somewhere in there would be your profit taking level. I would obviously stagger my profit taking if I was in multiple options, taking profits at this level and taking profits at this level here. If we go to Nvidia and we check to see what are the puts like here, is there a chance that we could sell some puts and potentially get Nvidia for cheaper? If we go out to the April 25th expiration, you can see here that you could potentially sell the 106 price puts on Nvidia, which have a delta of 18% or 0.18. You can sell that for almost $2 here, which you would get assigned Nvidia at 104 if you were assigned. Also, if Nvidia does ride this higher to at least here, then those puts would lose a ton of value and you'd be able to buy them back cheaper and make money. Nvidia is also following a very similar pattern to the SPY, right? Where we're potentially putting in a new higher low. This would be the first higher low through this whole ordeal, there I go again, that we've seen since January on Nvidia. Nvidia has just been a series of lows, highs, lower lows, lower high, lower low. This right here is a lower high. If this bases out, this would be the first higher low, taking us logically to this level, and this level is profit taking. Now, I would obviously be setting stops on any short-term trades that I take here. So you definitely, in my opinion, want to set a very tight stop on something like Nvidia. I would set a tight stop below 114 because I would want an immediate reaction here to the upside. So below 114 is where I would set a stop and potentially would re-enter if we fill this volume imbalance here. But I don't like to re-enter trades immediately without assessing what is going on a larger scale. Tesla is super interesting here because Tesla right now, it is exhibiting the usual volatility that you see from Tesla. Now, I've told you before that Tesla doesn't typically bottom out before April, May. It has in previous years bottomed out in April. In other years, it's bottomed out in May. We know that we do have potentially some updates on Robotaxi in June. Hopefully, they're pertinent updates showcasing to the market that Tesla is going to deliver on some of these AI deliverables. But from a technical perspective, we're sitting here in this gap that you guys know I thought we would get to at the 220 range. I actually did put in a buy in Tesla at the 220 range. I also sold some puts below 220. We are struggling to get above the 300-day moving average, so we definitely need to reclaim that, something that Tesla can do and has done before, falling below and above moving averages constantly. It is not a clean chart that adheres to these sort of textbook type of technical analysis readings. But if we pull up this on Tesla, you could see that the gamma is just all over the place. So if we combine all of the expirations, you can see that we have some significant gamma at 400. We also have some significant gamma around 300, but we also have some down here at around 200. If we drill down further, you can see that we do have some short-term expiration at around that 250 level. So if you were a short-term trader on Tesla and you were long, I would consider really taking profits right around here. I personally did not long Tesla with options and I would not do it just yet. But if you had some cash secure puts, like I talked about a few videos back, they would be up right now because we had a 5% day on Friday, and you could consider taking profits there unless you really want to get a sign on some Tesla shares. Then you would keep them open, hoping that Tesla hits that strike price so that you can get assigned those shares. It's crazy that the expiration with the second highest gamma is June 18th of 2026, and this is at the $950 level. Now, one thing to pay attention to with Tesla is on the weekly chart, you can see here these dojis. You have two dojis in this weekly fair value gap. So this could be setting up the base here on the weekly chart for a move, an expected move in April-May timeframe when Tesla usually bottoms and sees a nice delivery to the upside. Right now, what I want to see for Tesla before taking any short-term longs is a breakout and then a retest of that break level before potentially taking it long. So that one right there is on watch. I told you guys Meta would get to the 200-day moving average. I told you you can short Meta from here to get to the 200-day moving average. It didn't quite touch it, but it is almost at the 200-day moving average. Meta is a good value here. I did some analysis on it in the Discord, and I said that Meta was fairly priced and very consistent with its 3-year and 5-year history of valuation. It is not underpriced. It is very fairly priced at the 200-day. The stock that looks the most interesting to me for a long, for a potential long, I did buy shares here, is Amazon. So Amazon right here, if you take a look at the weekly chart, you can see we had resistance, resistance, resistance. We broke back above, retested it as support, and now we are falling there as support once again. Right at the 300-day moving average, you can see that Amazon is also oversold on the RSI for the first time since August of 2024 when we did hit the 300-day moving average. And this right here looks like a potentially low risk, high reward setup for a long. We are also in the weekly fair value gap here on Amazon, and it looks like the market is really paying attention to that 220 level on Tesla, on Amazon here. So right now Amazon's trading at 196. I think there could be a decent long to that 220 level. I would actually mark 215 as the take profit, only because in the short-term chart or the daily chart as opposed to the weekly, you have support here, resistance here. You also have the 100 days. So if I did take a long here, I would set my stop below 189 with the hopes of riding this up to that 100-day at this resistance and support level. And if we take a look at the options for Amazon, I'm just very curious as to how much these options cost right now. Let me see, because Amazon's been flatlined for a while. So if we go a month out, if we take the April 25th and we look at these calls, I don't make a habit of buying out of the money calls, by the way. And I think traders, that's one of the biggest mistakes that they make. But the 195 call is something that I would totally consider for Amazon in the short term. You can turn this into a spread by also selling the 200 call, and that way you don't have to pay a crap ton for that option. It would only cost you $3. Your maximum profit though would be $2 or $200, right? So you'd buy it for $3. If it's above 200 by April 25th, then the whole thing is worth $5. You paid $3 for it, you make $2. But your losses are way less if you are wrong, because the naked option in and of itself costs $8. And if you take a look at AMD right here is right on the cusp of a decision, right? We've seen AMD fail this trend line time and time again for almost an entire year, really since October 2024. But if you couple it with this trend line here, that goes back to July 2024 or this point here. And if you go to this point here, this is March of 2024. So the general trend has been down, but for sure, this violent engineered downtrend since October of 2024 is so hard for AMD to get above. We also have this former support point that looks like it's forming a resistance here. But AMD looks like it's ready for an explosive move in either direction, as it is just consolidating at this level. And AMD doesn't do well with consolidation, not recently. it definitely wants to break violently out of consolidation. You can see that consolidation here, break violently. You can see that consolidation here with the violent breakout. So in this case, if this consolidation remains, we are going to see a violent break on AMD. I do want to take a look at the options data and see how are the market makers and the options market pricing AMD right now, or at least betting on AMD right now. I think it's in a positive gamma condition here. Let's see. Yeah, it looks like it has a ton of positive gamma in the short term with negative gamma in the more medium term. But on both the March 28th and the April 4th expiration, it looks like that 110 is where the call wall is. My name is Paul Wall. I'm the people's champ. My chain light up like a lamp. All right, sorry, rap Tourette's. So I wouldn't be surprised to see AMD break out of this. And if you take a look at the weekly, I'm sure, yeah, this is a weekly fair value gap. So this weekly fair value gap here, it ends at 110. Not surprising, that's where that gamma wall is, at 110. So I would not be surprised to see AMD continue to crawl up towards that 110 before potentially getting rejected there. Even if you look on the daily chart at this October 29th level here, where it looked like we were going to peak above, it looked like a false breakout. If you look at this on the weekly, you could see that right there, it's just a wick into this fair value gap. So I personally still do not trust AMD. I do think it can crawl up some more, maybe to around that 110, 111 range, but it really needs to show and prove on the weekly above this and close above 112 for me to even consider taking a long on AMD. Now, I did talk about potentially shorting AMD, but right now, I'm not going to be shorting AMD. This is a show and prove situation here. And if the market looks like it is potentially on the cusp of a very temporary bottom, AMD is going to be a beneficiary or a recipient of that. So anyway, traders, that is it for this video. Hopefully, I provided you some insight into why I think the market will rally in the short term. Hopefully, I gave you some ideas for some short-term plays as well. If you want to trade live with me every single day and you want access to my swing trades, my long-term analysis, what I'm adding to my portfolio, come and join. Link is in the description below. And if you want a badass stock and options trading platform, come check out Public. Not only are the options trades commission free, but they pay you a rebate for the options trades. So make sure that you check out Public as well. Leave a comment down below. Let me know whether you think that my analysis is on point, whether you agree with it, whether you disagree with it. As long as you're respectful, I'm respectful to you as well. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace. And I'm sure you guys may have noticed, but I switched over to using Public for my investing as well as my option swing trades and selling cash secured puts. It's a regulated broker based here in the US. Now, the reason that I like it over other trading and investing apps is because not only are the options trades commission free, there are no commissions or no contract fees for options trades, but you also get a rebate for stock and ETF options trades. The rebate means that options trades are not only free, but you also earn money. They are less than zero. Now, the rebate is based on your monthly trading volume, so the more you trade, the higher your rebate is per trade. And for any cash that I'm not using, I could just throw it into a high yield cash account that they have and earn 4.1% on my money.